After just 2 days of very mild pullback, it seems as though all of the bears have come out of the woodwork to declare victory and say that this is officially the end of the market rally, to which I would say, how about no? There's some opportunity for the uptrend to remain intact with SPY daily higher lows above 403.75 or weekly higher lows in the vicinity of 390. We'll talk about these levels in just a moment, but for now, please be mindful of the major economic data scheduled to release this week. The CPI on Tuesday at 8:30 is the big one. It should cause a volatility storm. And speaking of volatility, there's a massive divergence right now between the VIX and the VVIX that I need to show you towards the end of the broad market analysis. Of course, anything that we're associated with is linked down below in the description, and if you're ready for today's video, drop a thumbs up. Let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we certainly have a bearish inverted hammer, which is noteworthy because it's a stark contrast to all of the bullish structure we've experienced so far throughout 2023. The large upper wick would of course represent a failure from the buyers to hold prices at the top of the range, and we get a reversal back down to the opening print, and because we have a red body, we know that we expand range underneath the opening print, and we've closed fairly weak in the lower third of the overall range. So to me, structure quite clearly goes to the bears. If we think about location though, things are not so clear with a bar-to-bar lower high and a bar-to-bar more substantial higher low. This leaves us with an inside bar, which is always much more indicative of balance as opposed to trending activity. Trending activity breaks a prior high and expands range in the upward direction, or breaks a prior low and expands range in the downward direction. Simply did not happen in the last week's worth of trade. Now you might make a more nuanced approach and say something like, okay, but we've closed underneath the prior weekly pivot high here. It's got to be bearish from a location perspective. And while you're not wrong, I would bring up the counter argument that simply says you could also look at the weekly resistance trend line and say that we've closed on the bullish side. We've closed above our weekly 50 SMA. So it's not so clear from a location point of view who's in control, but certainly from a structural perspective, sellers are in the driver's seat. If we think about what should happen here, we'll learn something on the weekly time frame when and if we break the inside bar high, or when and if we break the inside bar low. And with all of this economic data scheduled to release, I would certainly expect one of those two outcomes in the coming week's worth of trade. At the end of the day, context is always defined by trend, so we know that we have lows, and highs, higher highs, defining a weekly uptrend. So it would be completely reasonable, coming off of a higher high, that the weekly time frame chart is searching for a higher low. And as we alluded to in the intro, the perfect place for that to happen would be somewhere around the 390 zone. Makes sense based on prior structure, just all of these different interactions with roughly 390 to be the higher low pullback zone. We also know that from a volume profile perspective, it is the high volume node. There's SPY 390 right here, and we're just pulling back off of the overhead high volume node at 420. We've closed in the low volume void, and remember that the market is always searching for liquidity. It's most comfortable up here or down here. If we make a move back to 420, of course it's an equal high. If we get the pull back to 390, you'll note that yes, it is in fact a weekly higher low. It would pose some threats on the daily time frame chart, but we'll get to that in just a moment. I would like to reinforce the idea of 390 as a reasonable pullback with our Fibonacci's coming from the low all the way on up to the high. Notice that your 38.2 retracement is 391.55. Let's not split hairs here on the weekly time frame chart. 390 is easily a reasonable higher low on the weekly time frame. Moving down to the daily time frame chart to assess expected move, which by the way, here's a tutorial in the top right hand corner about how to find these numbers. We'll notice that we have a slight cause for concern here with the lower edge of the expected move being at 397.67. That of course would suggest a breakdown of the prior resistance point here, which we know we broke above, found newfound support, and rallied off of a classic break and retest, right? There's support. So underneath $400.75 is a cause for concern, and the expected move would suggest that it's well within the realm of possibilities in the coming week's worth of trade. If we're contained by the upper edge of the weekly expected move, it would be an equal high to the top of this most recent rally, which of course keeps the uptrend alive and well. Speaking of uptrend, let's keep trend at the forefront of our minds here, right? We have higher lows along the way, and there's still an opportunity for a higher low at 403.75. With the aggression from the pullback on Thursday, it can feel like the market is collapsing here, but remember, we're still in an uptrend and we're still looking to get involved on higher low pullbacks and equal high breakouts. Noting that we've come from the higher high, right? We've got highs, higher highs, and higher highs, it's still reasonable that the daily time frame chart could afford a higher low pullback. So I'm not overly concerned with the trend changing until we get some violation and close underneath 403.75, or more importantly, $400.75. Let's build the case for why 403.75 is the primary number to focus on. If we take a look from our Fibonacci perspectives, notice that it is the 38.2 retracement, which of course is your bullish consolidation. If we take a look at our anchored VWAPs, we'll also notice that it would be staying above our all-time high anchored VWAP, which is right around 402.42. That's slowly going to start creeping higher with price, as well as our anchor point, anchored VWAP here, to the most recent leg of the rally, confluence of support, right? So 403.75 does seem to be the key area, and we'll also note that that's exactly where the FOMC rally began from, so pulling back and holding this area does strike me as an important zone to find a higher low around. If we just quickly continue on down to the hourly time frame chart, notice what happened primarily around the spike from the FOMC rally. We had talked about in the past the sellers being unable to close this spike area in multiple different instances. Well, it's finally closed, and there's been no aggression from the sellers underneath the base of the spike at 406.50. Notice on Friday there was an attempt to break down from the opening range, no follow through from the sellers. And later that afternoon, you'll notice that we got an intraday higher low. We've also closed above this breakout point as of Friday at 4 p.m., which strikes me as a step in the right direction if the bulls are going to make substantial progress back in the upward direction. So overall, looking at the daily time frame chart, what's the roadmap going forward? Buyers definitely want to see a break above 410 with a higher low and then look for the move back up towards 416.75. Let's be very clear, based on the breakdown from Thursday, we kind of need this extra confirmation to be bullish on the market of the higher low or some price acceptance above 410 before blindly longing and trying to get involved on the higher low pullback. The more neutral outcome into the coming week, which I would not necessarily expect because of the economic data, would be a lower high underneath 410, but still finding a higher low above 403.75. And if you're a bear in this market, what you of course want to see is a breakdown of 403.75, really getting underneath $400.75, the prior breakout point from here, correct? And then finding a lower high underneath 403.75 to try to get back down to the weekly higher low at 390. That, of course, is also tradable from a pattern perspective, noting that we would be getting a head and shoulders pattern. The target could be that weekly high volume node at 390. From there, we would, of course, have to reassess, but as of right now, that's what I can see based on structure. Our first bit of supporting evidence comes from the market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. The first comparison that we want to make is between Monday and Wednesday's price action. Notice that on Monday we have about equal outflows from the market, but there's a stark contrast between the advanced decline line being pegged down below in the trend zone and being slightly sideways above the trend zone on Wednesday. It's still certainly underneath the zero line, but again, this is substantially more bearish on the Monday session. The same thing holds true for the cumulative tick. Notice the big build on Monday versus the very benign read on Wednesday. If we overlay that context with the actual price action sideways on Monday and more aggressive in the downward direction on Wednesday, I think the point and the conclusion to draw is that just because the market's experiencing some sell side does not necessarily mean that the bears are really driving momentum to the downside aggressively in every single instance. Of course, the next thing to follow this up with is, of course, acknowledging the downward pressure from Thursday's session, substantial outflows getting down to negative 300 million on the day's session. The overall weekly outflows were down around negative 600 million. It's not a billion, but it's certainly starting to edge on the sort of border of significance, so to speak. On Thursday, we go wall to wall from aggressively trending higher to back down and trend lower zone. That, of course, is a big concern with no pause whatsoever at the zero line. And again, on Thursday, the cumulative tick build certainly does get negative quite rapidly as an exponential curve. So we're not discounting the sell side from Thursday. We're just pointing out that not every sell day is exactly the same. Now, given what we're seeing here in the internals, the insanely neutral outcomes from Friday, I think that's why we need that extra layer of confirmation if we're bullish on the SPY with the higher low above 410 before looking to get involved in upside outcomes. Market profile also shows us some interesting nuances. If you don't know what the screen is, top right-hand corner's got you covered with a brief tutorial. Overall, let's focus on Friday's session from this perspective. Notice that value area here is completely inside of Thursday's session. It's not overlapping to down, which strikes me as a positive indication if we're going to see upward outcomes, or at least not as bearish as it could have been on the Friday session. The same thing holds true with the point of control actually migrating above the point of control from Thursday's sell-side day. We have still not accepted above these prior lows from here and here, so there is some work to be done, but overall value is higher in Friday's session as opposed to lower. We've also got a classic 45-degree line, and complete credit to Peter Resnicek over at Shadow Trader as well as Jim Dalton for coming up with this theory, which basically would indicate that sellers are getting shorter and shorter and shorter with worse location as the day wears on. You can imagine those shorts, if they have a short time frame outlook, would of course close out over Friday's high if we see early acceptance higher in the coming week's worth of trade. If we zoom out just a little bit, I want to point out the single prints, of course. So there are the single prints having closed on the Thursday session and no real acceptance underneath. Remember, that point of control is higher there. That does strike me as slightly more bullish than bearish. And I also want to point out that we've of course tagged up to the virgin point of control from the FOMC rally as well. So that would speak to the market not necessarily being in an overextended state to the upside. Once again, healthy in terms of the structure underneath us, remaining in a solid uptrend. Taking a look at the weekly performance of the sectors, we'll notice that energy outperformed at the top of the list here, up 4.85%, which is a slight concern for markets, noting its risk-off nature. The XLF followed, up 0.3%, and then we have the tech sector up 0.13%. At the bottom of the barrel is the XLC for communications, down 4.45%, primarily because of Google and the issues there, which we'll talk about in just a moment. We've got XLY consumer discretionary down 1.74%, and materials down 0.77%. So a slightly mixed bag from a posturing perspective, but the structural charts will continue to light the way. XLE for energy, yes, although it was up and outperforming, notice that it only had a gap green over red inside of the overall daily range. This will become much more concerning for markets if we start making higher highs above the top of this range at 93.25, so keeping a close eye on it, but not a concern for now. Financials are up next, and you'll notice that we have a nice sideways range above 36, the prior congestion area from here, which does strike me as healthy and bullish consolidation. A really nuanced perspective is also that on Friday, we've closed back inside of the Thursday breakdown bar range. Bullish outcomes continue over 37 in the XLF, and just like in the S&P itself, we need that confirmation of a higher low over 410. For bears, you need the confirmation of a lower high underneath 36 if financials are going to flip to the dark side, so to speak. Next up is the XLK for the tech sector, really going sideways up here at the highs. But what I like most about this structural chart is the hammer candle that tried to form on Friday, turning prior resistance into newfound support, into newfound support. So ideally, this stays above 139.25, but from a structural perspective, breaking down underneath that still could produce a higher low above 135. Now, intra-week, of course, that means some downward pressure, but I would keep a close eye on 135. This chart is not yet threatening to flip into a downtrend. Next up, we have the XLU for utilities. This is D for defensive, therefore we want to see it lagging the market, and notice that it's doing exactly that with highs, lower highs, lower highs. There's a strong opportunity that even with this rally from Friday, we could find a lower high underneath 68.80, which would be ideal for this market. Once again, these risk-off sectors don't want to fall off of a cliff. They just don't want to be outperforming and leading the market in the upward direction, which utilities certainly are not doing. So this strikes me as healthy. Communications, this is where there are obviously some issues with Google and the competition around AI, but let's think about structure on this chart. I mean, for now, there's still been dramatic improvements outside of this original balance area, and we've closed the gap from the Meta earnings, right? So all things considered, there's still a strong opportunity for a daily higher low to be found on the XLC chart. We're coming off of a higher high. It's in a picture perfect world, we find a higher low above 54.30, but you could imagine from a weekly perspective, because this rally was so aggressive, it wouldn't be unreasonable for the market to come all the way back down to 52.17, find a weekly higher low, and then continue. It would be a massive break and retest on something like the weekly time frame chart, or maybe even monthly, considering that this has been going on for quite some time. So although yes, intra-week it could provide more downside pressure, the structure underneath us does still have the opportunity to remain healthy with a higher low. XLY, consumer discretionary, let's speed it up a little bit here, finding the hammer candle on the Friday session, right around the prior top of the balance range right here. Once again, strikes me as fine and reasonable for a higher low. As long as we're above this gap area, I would say that XLY is not a concern for our markets, and we are holding the daily 200 SMA as well. So the primary look here would be a move over Friday's high to just get a rotation back up towards the top of this balance. 154.50 could be the target. This is a heavier weight risk on sector, worth spending the extra second on. XLB for materials is a lightweight sector, so let's keep it brief here. Overall, only concerning on lower lows underneath 80.75, with the breakdown on Thursday and Friday remaining underneath 82, the prior bottom of this balance here. Looks like it might actually continue to be a downward force for the markets, but again, lightweight sector. Improvements over 84.25. Next up is the real estate sector, much more to do with the wealth effect, coming in for the break and retest on the 39.85 level. As of right now, strikes me as A-OK. Once again, lightweight sector, much more to do with the wealth effect. As long as it's not making new lows underneath 37.25, good to go in real estate. Next up, consumer staples. Once again, a D for defensive sector. We want to see it lagging the market, and it looks very similar to the utilities chart, right? We've got lower highs, equal lows down at the bottom. Once again, we don't want it falling off of the cliff. We just want it lagging the market. And as of right now, it's doing exactly that with the equal lows. This could even just go sideways and do something like this. Doesn't strike me as a major concern for our market. We will get retail sales on Wednesday, which is noteworthy for our consumer staples sector. Next up is industrials. 8% of our S&P 500 still in the flag range, very much elevated, and a strong opportunity for a daily higher low above $100.50. This strikes me as bullish for our market, not a concern. Lower highs underneath $100.50 start to become the bearish outcome. Next up, last but not least, the second heaviest weight by market cap is none other than the healthcare sector. And notice that we're continuing to track this falling wedge, right? We've got this falling wedge, which is typically a bullish pattern. Although it points down, it is a bullish pattern. Just like we talk about the 45-degree line in market profile, indicative of shorts having worse and worse location, they're not getting paid as much on the downside. You could imagine that if we break the trend line or get acceptance back above 133.50, you could start to see a bit of a squeeze, I use that term very lightly, back up towards 137.15, which of course would be bullish for the S&P 500. We don't want this falling off of a cliff, and throughout this entire descent, it's been very mild and controlled selling. Doesn't strike me as a concern for markets yet. If we see a waterfall type sell here, of course that's a concern. So watch 130.50 and daily 200 SMA. We do have some pretty thin structure off to the left. That is an area worth noting and worth paying attention to, but so far so good in the XLV. Moving along to our ratio grid, I've got a tutorial for you in the top right-hand corner if you need to know how to set it up. Overall, the top 4 risk-on sectors continue to look fairly decent. Notice that the XLK is spending more time above the prior possible double top. That strikes me as being more bullish and risk-on than bearish and risk-off. The XLV is starting to undergo a bottoming process with a double bottom in place and a break over the neckline already. That's a healthy look. And the XLF is the slight cause for concern. We have a resistance trend line here, but recall that a break over the 37 highs from the structural perspective should accelerate this over the resistance trend line and continue the more risk-on look. XLY is getting a bit of a mild pullback here, and this does not strike me as a cause for concern, noting the significance of the reversal off of the lows and the quick recapture of the 50 SMA. The bottom 4 are the risk-off sectors, of course, and these are starting to look slightly bottom-ish. The reason I say that is the downtrend is not so aggressive anymore in the XLP. It's actually going a bit more sideways down here, although it's not above a double bottom neckline like our XLV is. The XLU has something similar. It's got a lower low double bottom, and it's 2, not above its neckline of that pattern. So they're not reversing completely yet, but once again, slowing down the pace of the descent in the risk-off sectors. Energy is the one cause for concern, outperforming on the week, but once again, 93.25 is the structural area that we're okay as long as we're underneath. And from a ratio perspective, it would be remaining underneath 0.23. XLRE real estate, much more to do with the wealth effect, going sideways here, not a cause for concern. Overall, the assessment from a ratio grid perspective is that risk on is still the primary force, but some things are starting to show signs of a mixed bag and a transition back to an uncertain time period. Let's move along and take a look at our XLY versus XLP. So we've got growth versus value. And just like we talked about in the XLY, a substantial reversal off of the lows, getting a little bit of mild consolidation and pullback up here towards the highs. but it's hard to say that this is a full-blown bearish look. For now, we would want to see a higher low produced above the prior double bottom here, and where we found a little lower high breakdown into the most recent leg lower in this particular ratio. That level is roughly aligned with our 50 SMA, the gold line, around 1.87. Let's have a look now at our dollar. Dollar certainly has an opportunity for a lower high around 103.50, noting that we are in an overall downtrend with lower highs continuously being produced. However, I would make the comment that from a structural perspective, this is starting to look much more like a bull flag, and we have multiple hammer candles stacking in the last week's worth of trade. A breakout to the upside here would of course have a negative impact on our S&P equities. And the reason why that, we're starting to look more into this as a breakable pattern to the upside, so to speak, is because if we compare this to the gold contract, which has a very similar structure with a bear flag, it looks like it has room to fall, of course, to get into that equivalent backtest area around 1820. That, of course, implying that the dollar could move higher, once again trickles down to a bearish excuse for equities to move lower. Let's have a look at rates and have some brief commentary about what's going on here. Of course, CPI on Tuesday should have a major impact. The lower highs are still intact on a weekly perspective, but on a daily perspective, notice that this could be construed as a double bottom, and we're also above that neckline. The acceleration into the end of last week is really what put some pressure on equities lower here in the much anticipated reaction from the Fed after the CPI numbers come out. Bear in mind that a move above 38.8 in the TNX would be a nail in the coffin for the S&P. I would not imagine that that is helpful for finding bullish outcomes. An interesting observation from our Fed tracker tool is that the probabilities of a 25 basis point rate hike have actually decreased slightly, while the probabilities of a 50 basis point rate hike have actually increased slightly. The opportunity for a hold of neutral rates has effectively gone to zero, and although this does not speak to Jerome Powell likely giving us a 50 basis point rate hike, it speaks to the market's anticipation that inflation could be rebounding, which of course would be bearish for our markets. Much more of a hawkish stance could be around the corner from Powell if CPI comes in off of the expectations, which is all the way up at 0.5 on the month-over-month read instead of the deflation we experienced last month, which was negative 0.1. If we take a look at the national financial conditions, this should make sense. The market should fear that inflation could be coming back with conditions loosening instead of continuing to tighten, which has been the goal of the Fed. Jerome Powell has spoken to tighter financial conditions in numerous occasions, and you can see that there was some progress made, but we are starting to undo some of that progress. So does he have to come back out as a hawk? It is a possible theory that would drive markets lower in the coming weeks worth of trade. How are we doing from an earnings perspective? It's noteworthy that we've got a 69% beat rate right now, which is below the 5-year average of 77% and the 10-year average of 73%. In terms of guidance going forward for Q1, there's an 82% response rate for negative guidance, which is above the 5-year average of 59%. This speaks to bearish outcomes in the future, or the more optimistic take would be the opportunity to beat the negative guidance as those reports come out. In terms of revenues, this speaks to leadership. Outperformers are utilities and consumer staples, our risk-off sectors, and you can see in aggregate utilities are leading, whereas tech is actually lagging. Being a risk-on sector here, it doesn't really bode well for the future of tech, at least if you're an employee. What's the easiest way to combat falling revenues? Well, it's to cut headcount and instantly improve the bottom line. We saw this with Disney most recently cutting 7,000 jobs, and this is something that we have to keep in mind in the long term. This does not speak to what we should do on tomorrow's session or even this week, especially noting that the unemployment rate on the monthly NFP is still stuck way down below at fairly historically low reads. Once again, this is macro narrative, not what we should do for tomorrow's morning session. Let's talk about risk appetite. Not currently seeing any flight to safety trade in the TLT bonds, with the ratio line coming out of the balance range that we're seeing here. Speaks to folks being comfortable with risk in equities, but to what degree? If we look at the HYG, notice that this did actually break down on the Friday session underneath support. So risk appetite, although it's still there, we're not seeing the flight to safety in bonds. It's being reduced ever so slightly in this divergence divergence between high yield and the equities market itself. This is also reflected in the Bitcoin chart, getting right back down to the top of the breakdown area over here. If we cannot hold 21.5, it would speak to a lower appetite for risk. Holding up here speaks to better than expected outcomes for equities potentially. How about the breadth of the market as we've been moving forward through this tumultuous time? A little bit of a rollover in new highs versus lows, back down at the zero line, which is not great, but it's also not deteriorating to the point of printing negative impressions on this chart. Remember that we want to avoid a look like this and morph into a look that looks something more along the lines of the rally we saw throughout 2021. Next up, we'll notice that the S&P companies over their 200 SMAs continues to be above the half mark. That again is bullish. This is not coming in aggressively. If we take a look at the companies over their 50 SMA in the S&P, it is also above the 0.5 mark. More than 50% of companies are above the 50 SMA, but we're also not in contrarian territory up around 0.9, so not worried about an overheating move, or an overheated move, I should say, in the upward direction. RSP equal weight S&P 500 is coming in for a perfect break and retest on the prior highs here, whereas you'll notice that in the S&P weighted, we're technically underneath. This would speak to an opportunity for the market to rebound and have stronger breadth underneath the hood and not just look at the few bad apples that are weighing lower on our S&P. Next up, we have the Dow Transports and Dow Theory divergence that we had talked about in the past. Notice that the transports are actually coming in, which was our theory that this would play catch up to the downside and we would not see a breakout in industrials. Currently is panning out as expected and keeping us sort of on our toes for the opportunity of a little bit of a breakdown. Now, if this does decide to break out and catch up, that would speak to, once again, improved bullish odds as we move forward. You'll notice in the VIX, we're turning prior support into potential new resistance. You'll note that we have an inverted hammer on Friday's session. So that would speak to bullish odds, right? VIX is remaining depressed. Well, not so fast. If we take a look at the VVIX, this is volatility of volatility, notice the massive expansion in the upward direction here. This doesn't speak to guaranteed bearish odds in equities, but what it would say is that someone is definitely hedging via VIX calls or SPY puts ahead of the CPI print and other economic data that is scheduled to release in the coming weeks worth of trade. If this continues to ramp higher and get towards that 120 zone, that would be cause for concern, and you would probably say, all right, let's be very cautious about bullish outcomes. If it backs off here, that would speak to a sigh of relief for our market, but nonetheless, I would still want to see the higher low confirmation in the SPY over 410 before getting involved in bullish scenarios, specifically because of the divergence happening here in our VVIX. If we look at volatility futures, we are still in a strong contango, no backwardation, speaking to present day risk being lower than future risk, which is what money managers want to see to start to allocate capital. Rounding out the remainder of our broad market with QQQ, notice that we have not filled the single prints. This is a huge difference between this and the S&Ps. Once again, if sellers were going to remain strong, those singles should have filled. You'll also notice that we're getting an indecisive doji right at a prior double top and resistance that broke in here. Could this be a weekly or even just daily break, retest, and rally? Absolutely the possibility for that. And once again, sellers not looking aggressive by failing to close the single prints down below. Into the coming weeks worth of trade, just like we need the higher low above 410 in the SPY, we would want to see the higher low above 302.75 in the QQQ. For bearish outcomes in the Qs, you need the lower high underneath 296.50, of course rejecting the single prints in between the orange dashed lines. If we move along and take a look at the IWM, remember that this is basically an indication for the risk sentiment of the market. Strong opportunity for a higher low on the daily chart around this prior area of resistance, big break, already got a minor retest around the area, and huge continuation to the upside. We've talked about this on many live streams. 188.90 is kind of the key zone that we want to reverse out of. You could treat it as literally a zone between 190.25 and 187.75. I would not be overly bearish in the broad market as a whole unless the IWM breaks down underneath this area, offers a big lower high, and then clearly we would have the head and shoulders pattern, right? That's what the bears want to see. And as of right now, the reversal and closure back inside of Thursday's breakdown range strikes me as, hey, let's take it easy with the bearish outcomes. We were looking for a reasonable higher low pullback. We're coming off of a higher high. Things are not all that bad just yet. So once again, speaking to broader risk appetite in the market, this to me has a strong opportunity for a daily higher low. And if we remain above this zone, bullish. If we start to get underneath the lower high situations, that's where we may start to change our tone for this current market. On the weekly trifecta, you can certainly see that the SPY has some work to do to get up and over its neckline of the potential higher low double bottom, or just remain on the opposite side of the inverted head and shoulders neckline. The QQQ once again has a strong opportunity to reverse off of the neckline of its double bottom, even on a bit of a further pullback, and the IWM already coming into the back test of the neckline here of its double bottom. Clear opportunity for a weekly higher low on all of the charts in front of us. Now would be a great time to drop a thumbs up if you've not done so already, and consider subscribing to the channel. Apple is up first for our core list of companies. I would say as long as we remain underneath 151, speaks to bearish odds looking for the gap to close from earnings underneath. That's 147.90 down to 146.60. Bullish odds only improve on the recapture of 153. In between 153 and 151, I would say no go on Apple into the coming week's worth of trade. Next up, we have Netflix finally breaking down underneath the double top neckline at 352.50 here, watching for continued sell side pressure until we get the retest of the top of the range here and the gap low at 333. If we get price action back inside or above 352.50, I would treat it as much more neutral and be patient, not necessarily looking for new money longs. Next up, we have Tesla. What's going on with the untouchable? A little bit of a pullback on the Friday session back underneath the breakout level at 197.50. I would be extremely mindful that price acceptance underneath 197.50 should send us lower into 182.40. But if we can remain above 197.50, you're really looking for bullish outcomes on recaptures and higher lows intraday above 202.25. That is the level. It's Friday's open, and then we would retarget the high of Thursday, the inverted hammer top, at 213. Take this one day to day. It is fairly extended off of these lows. Could it use a pullback? Absolutely. Is finding a higher low off of 182.40 acceptable? Absolutely, from a trend perspective. Here's Google, the big massacre based on AI. Notice the big pullback, especially after the Paris event and the sort of misspeaking, so to speak, of Bard. Offering the wrong answer. Regardless, in the AI race, it seems to be falling behind, and the stock price is reflecting that with a failure to hold on to 99.50. Because of that, we have a 3-bar play at the 50 SMA. Watching for a breakdown of the two equal lows at 94 sends us easily into 90.6. Anything underneath these lows are back on the table, whether or not you can believe it, at 85.75, almost a 100% retracement of the most recent rally. This is in a stronger downtrend than many things that we've seen thus far. We got tangled up around the 200 SMA. Weekly chart, definitely still bearish. We don't even have to consult that. Bullish outcomes only if we can recapture 99.50, right? It's clear as day. Any lower highs underneath start to form a head and shoulders concern, right? Bearish outcomes. If we get a higher low above, maybe we can change our tone, but for now, bearish on Google. Next up is Meta falling into the gap and getting some activity through it. Once again, I would not bet the farm on these particular levels from off to the left. They do not have as much importance because we've gapped through them, but 170.28, 161.89, and then the gap close all the way down towards the 200 SMA at 153.65. For upside bullish outcomes, it's got to be a recapture of 188.75 with a higher low to potentially watch for the break of these equal highs. Next up is NVDA. What's going on with NVIDIA? Certainly a little bit of a pullback off of this 229 level coming from the gap over here. Certainly reasonable that we could find a daily higher low on NVIDIA. The levels to watch are a breakdown and failure underneath 210. Look for the retest of 199.75 and then the higher low to be produced. I would doubt that we get an early reversal, especially if the market's going to be on edge awaiting CPI. But if we do, I would not necessarily look for the longs around 229. Just based on the extended nature of this chart. That might be a little bit too much of a personal influx of opinion there, but I would just be careful around 229 trying to find a new long. I would much rather prefer to see bull flag consolidation for some time, and then a break there after that consolidation gets us through the thin structure off to the left to target this gap close 252.50 up to 258.25. Next up, we have Microsoft winning the AI race, but still pulling back into the end of the week. But you'll notice we are in a daily uptrend with continued and sustained higher lows. This gap did hold on Friday as well, and we've closed right back in Thursday's range but significantly towards the lower end of that range. Nonetheless, bullish outcomes continue over this gap. That level is going to be 260.15. As long as we're in this range, scalps back and forth, absolutely fine. I would watch for the next big break over 274 to close the overhead gap, 282.50 up to 285.50. And bearish outcomes, maybe on a breakdown of 255.25 with lower highs there, send us for a retest of this area. The problem with that, though, is that we've already retested it here on the break, retest, and rally. Really don't want to see Microsoft back down around 242.25 if you're a bull. Current look, sort of decent, holding in there for now. We'll see if this AI sort of revolution keeps the stock moving higher. Next up, we've got Amazon. What's going on with this one? Another cause for concern, very similar to Google, to be quite frank with you. And the reason being is that you could call this like an hourly or 4-hour whatever head and shoulders pattern. And we're also getting some price acceptance on Friday underneath 99, the previous breakout high here. Notice that on, what was it, Tuesday, I think we had that beautiful hammer candle set up. There's no, sort of thrust from the buyers over that high, although we did wick above it on the Wednesday session. So big failure from the buyers back down underneath 99. I would watch for bearish outcomes. The breakdown level is 96. And it gets us back down towards the 50 SMA and the low from this bar at 92.25. A couple of trade ideas for you. PFE, Pfizer is up first, looking for a possible break over 44.35 to get a rotation higher here, remembering that the XLV is in a falling wedge. Could this turn into a daily double bottom? Absolutely. Over 44.35 squeezes, probably up closer to 47, the lows of this hammer candle in here. We've got fairly thin structure through that breakdown. I would watch for that to happen possibly sooner rather than later. Not in play if we violate 43. In the healthcare sector is also Abbott Laboratories. This is bearish, however, with a 3-bar play setting up right around the daily 200 SMA. A breakdown of 107.90 gets you down to 106. Prior support from in this zone here, not on the table if we get price acceptance above 108.60. Next up, we see BA, which has been on fire for really the past quite a while in the market. I mean, look at this massive outperformance continuing to chug in the upward direction. Big consolidation zone here. If we double that range to the upside, takes us much closer to 225, 227. And of course, with 3 days of consolidation inside bars from the Tuesday breakout, things are looking pretty good on a move over to 1490 for that continuation. Not really in play, obviously, if we violate the bottom of this structure here, which is closer to 215. Continuing along, this is a longer time frame pattern here, so just bear in mind that this might not be a day trade for this week, but something to keep an eye on is Monster Beverage Company. Look at this long period of consolidation for almost a month and a half now at this point, watching for a break over the top at 104.17. If we have a look at the weekly time frame chart, and this is breaking to new all-time highs, by the way, you could certainly classify this as a bull flag. A little bit of an indecisive doji 2 weeks ago, but last week inside bar above the close of that doji, once again watching 104.17, and a double of this range, just based on a quick eyeball test, certainly takes us right around 108-ish on the upside. So keeping an eye on Monster. If you made it to the end of the video, let me know down below in the comments section. Certainly always appreciate you tuning in. You can probably tell I'm on the mobile command station for today's video, so I appreciate that. I also appreciate if you watch this on Sunday instead of the Super Bowl. That's how I would know you're a true diehard trading fan. Anyways, wishing you all a green trading week. I will see you in the Discord for the coming week's worth of trade. Probably not live pre-market preps. We'll talk about why in the Discord. If you're interested, it is linked down below in the description. Completely free to join. Have a green trading week.